Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, we'll take a minor deviation from our normal conversation and shift our 4 points to be more of a rapid fire on macro key indicators. My intent here is to highlight key activities from the past week, but also put a strong focus on the macroeconomic environment. So, in point number 1, we'll still take a look at the market recap with our key market indicators. And in subsequent slides, we'll focus on other key macro indicators from the past week, and more importantly, what each one means to you and your investments. Without further ado, let's hop right in. We'll start a discussion with the market recap and our key market indicators. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 1.1% growth as of May 1st, which is great to see considering last week's projection was negative 2.3%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims rose by 19,000 claims, or 8.6%, ending at 241,000, while continuing claims also rose to 1.916 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates, ending at 6.76% and 5.92% respectively. Next, we'll look at investor sentiment. Now, one component of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread fell again from a negative 33.60% last week to a negative 38.6% this week. Once again, investors are continuing to feel quite bearish in the current market. Now, another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price-to-action relationship to the S&P 500. Now, we've seen this in real time with the market volatility over the past week, and more importantly, with market gains in the past week. Remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 are generally correspond to stable market periods. This week, the VIX ended at 22.68. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 2.8% probability of a 0.25% decrease and a 97.2% probability of no decrease in May. Now, we continue to see the probability of a May rate cut decrease week to week, especially after incorporating the data that we'll talk more about later in this video. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 2.87%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 2.83%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 2.35%. The biggest mover this week? Yep, growth in income stocks. Another great week for these indices. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Next, we're going to hop into the macroeconomic data quick update. So let's kick this off with an easy one. U.S. retail gas prices. We saw a decrease in the national U.S. gas prices in the past week, and based on the recent forecasts, the outlook for U.S. retail gasoline prices suggests a downward trend through 2026. Now, this is all primarily driven by anticipated lower crude oil prices. So while a decrease is expected in both 2025 and 2026, the rate of decline is still predicted to be less than the substantial drop seen in 2022 and 2023. All in all, still really good news to see gasoline prices come down. Now, a key metric that we've been tracking closely and certainly have been talking a lot about on this video is GDP, or gross domestic product. Real gross domestic product, or GDP, decreased at an annual rate of 0.3% in the first quarter of 2025. This is a significant change from 2.4% increase observed in fourth quarter of 2024. This downturn in real GDP primarily stemmed from an increase in imports, which subtracted from GDP, and a decrease in government spending. These negative factors were partially counterbalanced by an increase or upturns in investment, consumer spending, and exports. Following GDP, the story should turn to take a look at inflation. So let's talk a little bit more about consumer inflation. Personal consumption expenditures, or PCE, increased to $134.5 billion, which is a 0.7% increase in March, driven by increased spending on both goods and services, which you can see on your screen. A significant driver of this metric was motor vehicles and parts. From the preceding month, the PCE price index decreased less than 0.1%. Excluding volatile food and energy components of PCE, which is also known as the core PCE index, the price index increased less than 0.1% from the preceding month. Looking at the change for the same month 1 year ago, the overall PCE price index for March increased 2.3%. Excluding food and energy from 1 year ago, the core PCE index increased by 2.6%. All of this data, which is highlighting how sticky inflation has been, it still remains a problem, and it's still quote-unquote sticking around. However, it's much more tame than over the past 18 months. The next key indicator, or in this case group of indicators that I want to share, is around jobs. This group includes the ADP unemployment report, the ADP payment report, non-farm payrolls data from the BLS, as well as the labor force participation. Now, I believe that all four of these metrics are important to paint the picture around what's happening in the jobs market. So to kick this off, the ADP National Employment Report for April 2025 indicated that private employers in the U.S. added 62,000 jobs. Now that sounds great. However, this was significantly down from 147,000 jobs in March of 2025. Hiring was described as moderate in some sectors, while education and health services, information, and professional and business services experienced job losses. Now, this report is an independent measure based on real-world payroll data from over 25 million employees and is not intended to forecast the government's jobs report. So separately, the ADP Pay Insights for April revealed that pay gains remain steady, meaning year-over-year pay for job stayers increased by 4.5%, a slight deceleration from March, while pay for job changers accelerated from 6.7% to 6.9% in April. Now, on the other hand, the U.S. Bureau of Labor Statistics, or the BLS, reported that total non-farm payroll employment increased by 177,000 in April, which is a gain roughly aligned with the average monthly increase over the past 12 months. The unemployment rate remained unchanged at 4.2% in April and has stayed within a narrow range since May of 2024. The number of unemployed people was little changed at 7.2 million, while unemployment rates for major demographic groups showed little to no change. However, the number of long-term unemployed, which is defined as joblessness for 27 weeks or more, increased by 179,000 to 1.7 million, representing 23.5% of all unemployed people. Both the labor force participation rate at 62.6% and the employment population ratio at 60% changed little in April and year over year. The U.S. manufacturing sector only saw marginal expansion in April 2025, with the PMI remained flat at 50.2, which is just above the no change mark. This marginal growth occurred alongside a fall in output for the second consecutive month, despite some ongoing concerns. The new report, new export sales notably declined, the sharpest drop since last November, with tariffs widely reported as the key reason for the decrease and also blamed for a slump in overall export orders. Tariffs, supply disruption, and cost concerns linked to the weaker dollar are also reportedly contributed to a steep increase in both input costs and selling prices, with output charges rising at the greatest degree in over 2 years. Overall, the report paints a picture of a manufacturing sector facing challenges from tariffs and uncertainty, leading to a falling output, declining exports, job losses, and rising costs. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. Hopefully you enjoy the new format that I'm testing. I'd love to hear your feedback in the comment section below. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.